ADP reporting that November jobs in the private sector rose by 307,000. That's below the consensus of about 475,000. Sorry. October payrolls revised from 39,000 to 404,000. They revised it up relative to the BLS report from the prior month. It's a pretty good report. Goods sector, 31,000. Services sector, 276,000. You can see the non-farm payroll there is higher for the consensus for Friday. But this is a good report, and I'll give you two reasons. First, let's look at the job growth by business size here, and you see that it's pretty good spread across businesses. Maybe large businesses not doing quite as well, but they had done well. But small, medium, and large all showing gains. And then when you look by sector as well, leisure hospitality, one of the hardest hit, has done well each month and doing well again. Education, health coming back. Pretty good, construction, 22,000. Those are good numbers. Let me give you two reasons why this is good news. First of all, ADP has been underperforming the BLS by about 10 million jobs during this pandemic. So that number may be light relative to the BLS. The other thing is, guys, I've been talking about this. The high-frequency data has been kind of gnarly. It's been suggesting a negative number. We've been talking about what's been going on with the UKG, formerly known as Cronus. But here's a quote I want to give you from Homebase that I got late yesterday from their report. And what they said, I don't know if we have the quote up there coming up. Yes, they do. Our businesses open metric declined noticeably, and this is for November, ending a period of stagnation and initiating a clear decline across all metrics. So, Becky, the high-frequency data pointing towards not a great number this Friday, but the consensus of Wall Street has been relatively high, and this ADP number maybe takes some of the edge off of the possibility of huge downside risk anyway.
So, Steve, who do we believe when the data that we normally rely on doesn't match up with the high-frequency data that we've been relying on more recently?
Look, I'm all in favor of criticism of the economist during normal times, but you have to cut the whole process a little slack here. Nobody has ever forecast job growth in a pandemic, on again, off again, lockdowns. We have not really been using the high-frequency data through a whole process here. I'll tell you that my plan was to start to introduce some of this data very slowly, one at a time, and then the pandemic hit, and all of a sudden, we're all using this. So what I see and I think is interesting and telling about right now is, for example, J.P. Morgan's own data showed the high-frequency data, its own model showed a possible decline of 800,000 jobs for the report this Friday. What did they go with? They went with a jobs report or forecast for plus 400,000. So they're not relying only on the high frequency. They're still using their old methods of putting it together. Who's right? Well, let's talk at 8:31 on Friday morning.
Shepard Smith here. Thanks for watching CNBC on YouTube.